Hi, thanks so much for tuning in. You're watching the Mutual Fund Show. My name is Alex Matthew. Equity markets in India are very close to all-time highs. And if you are someone that tells your friends and family to go whole hog into the equity markets, to deploy as much as you possibly can, then you'll be feeling vindicated. But the thing about it is that not just right now, but at almost any point of time, a multi-asset strategy would probably hold you in a better stead, would hold you in good stead. And the reason is not just because it would protect your downside, but it turns out that it could actually hold you in good stead even when the markets are listless. To talk about this more, I'm joined by Kalpen Parekh, who's the MD and CEO of DSP Mutual Fund. Kalpen, thanks so much for joining in. And we often speak about an asset allocation strategy, but we're today talking about multi-asset. And I think the presentation that you sent my way was very interesting because it had a lot of data points over a long period of time. Why are you saying that having a very large equity allocation over the long term is not necessarily the best approach to take?
Actually, I think we say that over a very long period of time, equity is has been proven to be the best asset class,
Sure.
but only for few countries. In fact, a couple of days back, we published one data point for all emerging market countries since the beginning of 2000. In their local currency terms, their equity markets actually underperformed gold, and this was actually a bit startling. Now, of course, this has some start point and end point bias because 2000 was, in a way, a bubble peak for emerging markets, and then they had sharp currency drawdowns. India has been one of the very few countries where there has been policy stability, there has been macro stability, barring few years here and there, because of which our currency has remained stable. And we've had good entrepreneurship where profit pools go back to shareholders. In many emerging market countries, first of all, profit pools are shallow or not consistently growing, and they do not go back to shareholders. So India has been in a way an outlier apart from US, where for long periods of time, equities have actually delivered 6 to 7%, or rather 5 to 6% extra return over inflation. See, there's no point in looking at returns only in absolute terms like 15% or 20%. Ultimately, how much more do we earn over inflation is what matters. So India and US have delivered, very good long-term secular returns for their equity shareholders. But in this journey is laced with periods of 20 to 40% price falls in between. Every 2 3 years, there is a 20% price fall. Every 7 to 8 years, there is a 30 to 40% price fall. The reasons could be different. The reason could be international crisis, it could be local crisis, it could be currency-led corrections. We don't know, and I cannot forecast what the next reason also would be or when the next correction would be. Now, there are two types of investors. One who don't get affected whatsoever by these corrections, who in fact enjoy these corrections, who rejoice in these corrections, and who are able to take advantage of these corrections by actually investing more or looking through them. So that's the first group of investors for whom equity is the best asset class. There is another group of investors who panic from corrections, who think that when prices are falling, I should get out of the market, and actually they end up distracting or hurting their asset allocation or skewing it away from being in equity when prices actually have become cheaper. Now, so asset allocation strategies, multi-asset allocation funds are suitable for the second group of investors. And if we were to look at the entire universe of investors that we see investing in any asset class or in mutual funds, most of us tend to be in the second group where we chase past performance. There are very few investors who have the temperament or the resilience to live through equity fluctuations and valuations. And which is why we feel for people at large, asset allocation funds, multi-asset funds, offer a very disciplined way of investing in tomorrow's winning asset classes and not just in yesterday's winning asset classes. And that is exactly the reason why we believe that, till you do not become a pro at equity investing on your own, till you cannot digest fluctuations and volatility on your own, take advantage of multi-asset allocation funds. Now, what does multi-asset mean? Here, we also are introducing asset class like gold and global stocks in the portfolio. And these two asset classes in the long term have again given returns closer to what Nifty would have given over a full cycle. But they behave many times in opposite direction. They have low or negative correlation. So without compromising on the long-term absolute return that each of these asset classes give, when you mix them, they actually increase the ability to withstand fluctuations because they fall much lesser when markets go through sharp drawdowns. But they don't compromise too much on return, and that is why I think multi-asset makes a lot
Yeah,
of sense.
I want to get into the nitty-gritties of multi-asset, but before we go there, you mentioned correlation, and which actually brings me to the second point, which I think a lot of investors face, and those that have been in the markets for some time and even choose to invest through mutual funds itself, they think that if they diversify either through a market capitalization strategy or otherwise in terms of approach, they are diversified and they can protect that downside. But the data that you've shared with me suggests that that doesn't necessarily pan out.
That is not diversification in the first place. Remember, when you're buying stocks, period, whether they're large cap, mid cap, small cap, that's not true diversification. In fact, they'll give you the same risk of equities. When, in 2008, markets crashed, Nifty fell by 57%, small cap index fell by 70%. So where is the diversification? So when you're buying stocks, there is no diversification. When you're buying bonds, all bonds will fall more or less in the same pattern. So diversification truly means diversifying into asset classes which are actually not friends of each other, which means they go in opposite direction at different points in time. So the period from 2003 to 2007, equities had a blockbuster move. Nifty went up 7 times, small cap went up 15 times. But in those 4 years, interest rates actually rose back in India and bonds did not deliver. And gold was just marginally going up. From 2008 peak till 2013, Nifty first fell by 50%, then doubled back, so it came back to the same value. And for next 4 years went nowhere. 6 years of zero return. Gold went up 350%. So that's diversification and low correlation. When one asset class is zigs, the other zags. They don't move in the same direction. Yesterday, after the great victory that we had, and when Mohammad Siraj took 6 wickets, I was asking my son, if you had to build a team, how many Mohammad Siraj will you have? And thankfully, he did not say, I want all 11. Because that's not diversity. You also want to play in different types of scenarios.
Yeah.
So good diversification means that you will never own the best performing asset class only, but it also means you will never end up owning the worst performing asset class completely. So it always will give you middle of the pack returns. And in some patches, it could give you the best returns also. But the benefit of diversification is, what Morgan Housel says beautifully, that it creates a design which allows you to stay invested for long periods of time. And if you stay invested for long periods of time, compounding is taken care of, and automatically wealth creation happens. The challenge with single asset class investing is we always chase the asset class which has done well yesterday.
Yeah.
But my money was not invested yesterday; it's getting invested today. So when Nasdaq did very well in 2020, a lot of money went to global stocks and global funds. But next 1 year it underperformed.
Yes.
When small cap, mid cap are doing well today, money is coming today. It should have come 1 year back, 2 years back. Only then would you have won those returns. I think these are not easy, nuances for consumers to understand, and which is why we believe in mixing these asset classes in a certain proportion.
So when we've spoken in the past, and I know, Kalpen, that you and I have spoken about this as well, is that when you have a mathematical formula, for example, and you have your own asset allocation strategy based on what you think is appropriate, and you do a kind of a do-it-yourself approach where you have, say, 60% allocation towards equity, 30% towards debt or fixed income, and then 10% to gold. And whenever you see, for example, a Nifty 50 at close to 20,200, which will have skewed your equity component to maybe a 70%, that is a good opportunity for you to press that sell button and maybe have more fixed income. This is traditionally how people do it. But this multi-asset fund kind of does it for you. Is the primary benefit what you pointed out earlier for those that cannot make that decision? Or is it also the tax aspect that proves to be a benefit over the long term?
Actually, both. So, the first thing is, as you said, so even for me today, let's say when my equity exposure has got tilted to 73 right now, ideally I should, rebalance it if I am disciplined. I may end up not rebalancing it either out of laziness, out of, being busy with a lot of other things, or out of greed. Right now, there is a greed element inside me saying that, run with the market, stocks are rising, flows are coming in. I'm justifying to my own self, rationally or irrationally, saying that let this asset allocation continue. So left to myself, I may not even do the right thing as I'm supposed to do. Whereas in a fund where there is a structure well defined, which says that whenever certain thresholds are crossed, rebalancing will have to happen without informing you. And that is the beauty of discipline. That the structure will keep rebalancing whenever any asset class crosses certain outlier returns in a current cycle. Secondly, when I do it on my own, or when you as investors, we as investors do it on our own, we end up incurring transaction charges or tax costs and the loss of compounding on the amount of tax that gets calculated in every rebalancing. In the last few years, what has happened is asset class cycles have also become very fast and short. So a lot of times you may want to rebalance faster versus in prior regimes. So all these rebalances, if you want to make them tax efficient, a mutual fund structure allows you to do that, and gives you the benefit of scientific, disciplined rebalancing with reasonably low cost and superior tax efficiency.
I want to specifically come back now to the multi-asset strategy that you employ, and how do you describe the thesis behind it? Because this is quite a wide margin that is available to you. Equity can go anywhere between 30% to 80%, but I believe that you generally have it around that 50% mark. Is that right?
So let me explain to you. See, while in our design we have created leeway to go to certain extreme points only in extreme situations. But at large, we believe in discipline, we believe in structure, we believe in templatizing things upfront, because we believe that discipline is superior than all of us as individuals. While we are talented, hope to always do better, but we have always learned discipline works better. Our portfolio, for example, let's say today, if you were to deploy the portfolio, would have around 40 to 50% in Indian stocks, around 20 to 85% in global stocks. So collectively, it will give around 70% weight to equities overall. But it will be two types of equities, global as well as domestic. And why does equity demand a better tilt or a higher tilt? Is because generally in the long term, equities beat inflation, they give you real rate of return. So all points in time, equities will be closer to around 60 to 70%. Only at X, and then because it is multi-asset, it should do justice to other asset classes. So gold minimum will be 10, bonds minimum will be 10. But at this point in time, we also believe that stocks generally are richer than what we would have loved them to be. Valuations are higher than what gives us significant comfort from a margin of safety point of view. So instead of 80% stocks, we would be 60 in stocks, or maybe 65 in stocks. And the balance gap will get filled up by bonds and gold. And why so? Because bonds also, yields have risen in the last 18 months very sharply. We are very comfortable with Indian bond yields at 7.5. With very balanced macro, bond yields are now giving us reasonable cushion over inflation. We have real rates almost 2.5%, highest ever probably in this regime. In across any country, we have a reasonably high amount of real rate. Gold again as an asset class over last 10 years has gone nowhere. Though last 1 or 2 years it has done well, but 10-year return of gold compared to equity is half, whereas over 25 years gold and equity have given very similar returns. So in a way, gold has delivered lesser than its potential, and we like to invest in an asset class which is currently earning lower returns, so that when future returns come, it is meaningfully there in our portfolio. So which is why it will be comfortable right now to have 65, 17 stocks and 13 bonds and gold. And within these stocks, it will be a mix of global and Indian. Now, when we go to 80% stocks, is let's say something like COVID happened and markets crashed by 40%, valuations are at 14, 15 times, or even cheaper at times, is when we'll say that okay, now there is more safety in equities, because margin of safety is there, valuations have come down. Of course, that time headlines will be very negative, news flow will be very negative. We may not even know how the economy is going to be, but that's when you get cheap prices. So only at such extreme points will we increase equity. Likewise, if equity is going to a bubble zone, let's say valuations go to 30 times on Nifty, where we are at 20 feet right now. If that were to happen, this 65, 70 in equity could go down to around 40, 45. And we would balance the balance amount to bonds and gold. And lastly, why do we think about these things? Is if you remember, Alex, every time markets fall, we are inundated with interesting quotes from Warren Buffett or experts saying that buy more when there is blood on the street. But to buy more when there is blood, you need some cash flow from some other asset class which has not fallen, and that's where gold and bonds can create that liquidity, which is very precious on days when markets are sharply correcting.
Comes back to where we started, right? If you're 100% deployed in equity, then you have nothing to play with when you need to deploy. And I think that sums it up perfectly. One last question on your strategy. The multi-asset fund allows you the opportunity as a fund manager to also invest in InvITs and REITs, and it allows you to invest in commodities as well. Is that something that you have considered? Is there a reason why you didn't mention it?
The reason I didn't mention it is that, see, these are very nascent asset classes still in India. There are a handful of instruments which have just come in the last 3-4 years. And, many times very theoretically, we say that, when there is inflation, REITs will do well or InvITs will do well. But, at least the data or evidence does not yet suggest, because there are many other variables which play a role in the performance of either of these InvITs or REITs. So in the last 18 months, while inflation has, risen everywhere in the world, but in fact, in the same period, stocks have delivered better returns than InvITs or REITs everywhere else in the world as well as in India. So it's a new asset class. We would want to spend some time, seeing it season, seeing more options becoming available. We have an enabling option to invest in them. In some of our funds, we do have 2 to 3% in InvITs whenever their yields were very high, because in the last cycle, some of these InvITs had seen significant price correction because one part of their retail shareholding, they were actually selling it, after the earlier hype and listing. So we just took advantage of those lower prices. So to some extent, we had a small component, but at this point, I would say that's not a dominant part of our strategy. We'll see and wait and watch for more such instruments to get listed. And once we get more confidence, comfort, when we also come up our learning curve, we will evaluate these strategies.
Fantastic. All right. I think that sums up today's conversation. Kalpen, thank you so much as always for taking the time. Always a pleasure speaking with you.
Alex, thank you so much. All the best.
All right. So we've been speaking about the use of multi-asset funds as opposed to a broad multi-asset strategy. But how should you employ it? What kind of investor should look at multi-asset funds, and where should it fit in your portfolio? To speak about all of those aspects, I'm joined by Nikhil Kothari, the director at Etica Wealth. Thanks so much, Nikhil, for taking the time. What, according to you, is the role of a multi-asset fund? Who should invest in it?
See, as an investor, right, you can primarily invest in 5 places only, which is your Indian equities. You can invest in international equities. You can invest in debt, fixed income. You can invest in gold, and you can invest in real estate. Okay. Now, if you have a very large corpus, you can divide your money in different asset classes, depending on your risk appetite, your time horizon, and your investment outlook. But if you are retail investors and not have such a large corpus to divide across different asset classes, and your risk appetite is moderate, then this asset class works perfectly for you, because you can invest your money in one places, and depend on the fund manager's outlook, depend on your risk appetite, broadly the fund manager can allocate money in different asset classes. And as you've seen that all asset classes do not work in tandem. Sometimes gold may perform, sometimes equity may perform. So overall, this portfolio brings down the risk quite substantially. And on an average, it gives you better than, if I have taken average return, they give you better than 2 or 3 asset classes. They may not be the best performing asset class, but they will be, in terms of return, the average return is far better than other, I'm saying, if you have only taken one asset classes.
Okay. All right. And who should invest in it? So you've mentioned you need to have a moderate risk appetite, because I'm trying to understand it. It would obviously depend on the fund manager's approach, but by and large, we're talking about a 50% allocation to equity and 25, but this equity can go anywhere between 30 and 80%, right?
That's right. So every fund houses have a different strategy of managing a multi-asset fund. So you need to understand the strategy of the fund house itself. Okay, there are few fund houses which have a static of 65%. Few fund houses have a range from 30 to 80 as an asset allocation. Now, how the fund manager manages money. So fund manager, if he believes that the equities are overvalued, then he will reduce the equity allocation and invest in arbitrage, invest in debt, invest in other asset classes more. And if he believes that the markets are fairly valued or undervalued, then you will increase the equity allocation for more. So this fund gives you exposure that if markets are overvalued, the equity exposure reduces, and the fund is undervalued, the equity exposure increases. So the fund manager does this work for you, which you don't have to do on your own. Now, when you're investing in this fund, since this fund invests in equities, you need to have a minimum horizon of 3 to 5 years. If you have a horizon of 1 or 2 years, then it may not be a great strategy because equity markets may underperform, and good because sizable part of the money is in equities, so your fund may underperform the fixed income asset allocation. But if you have a 3 to 5 year horizon and you're not able to manage in terms of changing your equity allocation based on market outlook, and you want exposure across different asset classes, then this fund is the right fund for you.
Okay. Now, we've often spoken about the need for asset allocation strategy. And even when we talk about mutual fund investments, we're always talking about looking at equity, looking at diversification within equity, and looking at fixed income. We've also spoken about hybrid quite often. Why is the multi-asset strategy something that you should consider? Should you consider it as opposed to a combination of equity and fixed income? Can it replace that? Do you work it in conjunction with what you're doing right now? How does it work?
Okay, so see, over a long period of time, we know that most of the time, equities as an asset class will outperform most of other asset class. So if you have a 10 to 10 year plus horizon, then you can invest in equities and stay invested for long term. But what we need to understand is that markets are not linear. Markets will be always volatile. So there may be a period when one equities may not perform for 2-3 years, right? So if you are an investor, which you get panic with those time frame, then multi-asset funds works perfectly for you because in here you will have different asset classes, and even if equities are not performing, either gold may outperform or fixed income may outperform. So your overall risk may comes down, and you still get an average return on the overall portfolio. And just to give you a perspective, like in 2020, right, during the year of COVID, gold was the best asset classes, right? And if you look at 2021, US equities was one of the best asset class. If you look at 2023, okay, today we are talking about US equities again outperforming. If you look at tech index, but if you look at last 6 months, Indian equities have outperformed, right? So what we've seen is that at any point of time, it's not that one asset class will perform every year on year. So you'll have different asset classes performing at different point of time. So multi-asset gives you overall brings a risk, reduces the risk because of low correlation between asset classes, and your volatility comes down. Right? But if you're looking at something purely from a long-term perspective at 10 years and I want to get the best return, then I think equities may be a best option for you. But if you're looking at reducing your overall risk, then multi-asset funds make sense for you. How we look at from a client perspective, that you will have always equity exposure. You will have some amount of fixed income exposure, which is the money which you need for 1 to 3 years. But if you have a money which you require for 4 to 5 years, okay, then multi-asset fund works better for you because here you may get slightly better return than a fixed income, and not as volatile as equities. So it works in terms of increasing your return slightly and reducing your risk as compared to equities. Now, if you look at today's environment, okay, when markets are slightly expensive, okay, because you've seen markets have run up quite a bit in the last 6 months, and if someone wants to invest lump sum money right now, okay, in that case, multi-asset fund may be a slightly better option as compared to investing in pure equity fund, because in short term it may be volatile, and multi-asset fund may be less volatile as compared to pure equity fund.
Okay, but my takeaway is if you've got a 4 to 5 year time horizon, in general, it's something that you can consider doing, and particularly now because valuations could be a little bit stretched in the equity market. And because of the kind of money that's running after small caps in particular, perhaps you can consider looking at that. How do you gauge the performance of a multi-asset fund though? And the reason I'm asking is that you have a lot of new names that have come into the space. How do you gauge whether this is the one that you need to get as opposed to something else?
So first, when you're looking at multi-asset fund, your primary objective is consistency. You're not very, very comfortable with too much of volatility. Right, so you need to look at fund which has been consistent over a period of time, okay, whose standard deviation is slightly lower than most of other asset classes. Because if you're willing to take a non-linear payoffs and willing to and you're able to adjust the volatility and you are able to digest the volatility, then you better, and if you're long-term horizon, you be in equity funds only. But you invest in multi-asset fund because you want to reduce the overall risk and you don't have that much risk appetite. So you should look at fund which is consistent, who has across time frames. So look at a longer track record and who has done good over a period of time. Secondly, you have to look at whether they invest in across asset classes. So you shouldn't look at only a multi-asset fund which is only investing in debt and a very small portion in commodities and a very small portion in fixed income. It's primarily, say, long only equity fund only. Because in that case, the objective is not met. It's not a pure multi-asset fund. So you should look at fund which has got who can change the equity allocation based on the valuation of the market, who will invest in international equities also, who invest in gold also, who invest in debt also, and who can also invest in REITs up to a small portion. So then it's a pure multi-asset fund. And here, based on the fund manager's outlook, he can invest in different asset classes. So I'll say that look at fund which has got a long history, who is consistent, who has an objective to invest across asset classes, and they are not only biased towards one asset class, they have investment across asset class. And if from a taxation perspective, if you get a fund which falls under the taxation, say for example, where it's not a pure debt fund, which is tax as per tax bracket, but if it's a fund which gives you say 20% with indexation benefit, where they invest up to 35% in Indian equities, so that fund from a taxation perspective also may be a viable option for you. And last, most important, should look at broadly the expense ratio. You should not look at fund which is very, very high on expense, because here your overall returns is slightly subdued as compared to pure equities because it invests in across asset classes, right? So look at expense ratio, look at consistency, look at whether they're investing across asset classes and they're not only biased towards one asset class. And if they have a taxation, which is a debt taxation, which gives you 20% with indexation, then that fund be a right choice for you.
Not debt, as in no, the erstwhile debt taxation.
Erstwhile
right?
debt, erstwhile debt taxation.
We're so used to saying that. No? All right, no, but
Yeah.
I must point out that we spoke with DSP on the earlier part of this show. So I do want to ask what your recommendations are. Kalpen kind of laid it out for us in terms of what DSP does on its multi-asset fund. What, according to you, are the funds that stand out in case our viewers want to go and make an investment?
So there are a few funds like a UTI multi-asset fund, which has got a long history and they've done reasonably good over a period of time. There's a Nippon multi-asset fund, which also invests in different asset classes, across which gold, commodities, realist REITs, some amount of REITs, Indian equities, international equities. So you can look at Nippon multi-asset fund. So these are primary two funds which you can go ahead and invest, apart from any other fund which falls broadly your criteria in terms of the 5 points which I mentioned.
Fantastic. All right. So I think that kind of sums this up. Thank you so much, Nikhil, for taking the time and for speaking to BQ Prime.
Thank you. Thanks a lot. Thanks.
All right, there you have it, viewers. That's the conversation about multi-asset funds. Do let us know what you think, and if you've got any questions for us, write to us on any one of our social media platforms. It's been a pleasure bringing this show to you. Do stay tuned. This is BQ Prime.